All right, and we are live. Good evening, everybody, and welcome to today's presentation. We are going to be reviewing the third quarter of
Second.
second quarter. We're now in the third quarter. We're reviewing the second quarter in the markets as well as in our portfolio. So, thank you very much for taking the time to join us this evening, and for everybody who is going to join us in the future on the recording, thank you in advance for joining us as well. Dad, if you can move forward.
Go ahead.
I can't. You're controlling the slides. There we go.
Mm.
So our usual disclaimer, we're going to be using some charts, graphs, pictures, and tables in this presentation, and they are meant to be used for illustrative purposes only and are not intended to represent any future outcomes or results. And just as a reminder to everybody, I know everybody probably visits this page regularly, but just in case you don't, please continue to visit our website, medwealth.ca or johnsutsos.com. We have lots of helpful information on there, including information about upcoming events. We just had a great event last month, and earlier this month, and we look forward to hosting future events like this one and other social engagements in the future. So it's a great idea to always be checking in on the events tab to see what's coming up next. And just as a friendly reminder, we also have our podcast, Prescribing Prosperity, which is available on all the major podcasting platforms. You can use your phone right now and scan the QR code. It'll take you directly to that page, or you can go to your preferred podcasting platform and you can just type in Prescribing Prosperity and you should be able to find us. I believe we're now at 47 or 48 episodes. I don't remember off the top of my head. 48 have been 47?
Yeah, have been released.
Yes, 47 been released. Okay, perfect. All right, you can move forward. All right, Dad, you can take over from here.
Okay. Let's first of all, I'd like to personally thank everyone who's both on this webinar and to all of our clients who've been with me for a very long time. Some of you have been with me from the very beginning, which is now 39 years ago. Next year, I will be celebrating my 40th anniversary, but certainly nearly 4 full decades of experience in the financial markets. So in the last quarter, we've received a lot of questions and concerns from our clients. It was probably the most consequential quarter in the 4.5 years that we've been managing the MedWealth model portfolio, with tremendous changes occurring in the United States and around the world, and it had significant impacts on the capital markets and on the economy. Among the questions we received this quarter from a number of clients, what is the impact of the Middle East crisis? Those questions originated around the middle of June. Should I be making portfolio changes? Individuals asked me that question, and Alexander that question during the height of the turbulence in the second quarter, wondering if they should be making any active changes to their asset mix between stocks and bonds. How about investing internationally? Some people brought up the issue of capital is leaving the US during the tariff negotiations and going into other markets around the world, and maybe we should be doing the same. What is the impact of the Chinese DeepSeek artificial intelligence platform on NVIDIA and other tech giants in North America? And we received that question from a client in June. The future of the US dollar hegemony, meaning US dollar as the global reserve currency, is that in jeopardy, or will that likely continue? And what is the expected speed of the market recovery following the collapse in stock markets at the beginning of April? So during the course of this presentation this evening, all of those questions will be answered. However, I will answer one question right up front that will likely not be answered by the following presentation, and that is the impact of DeepSeek on NVIDIA and other tech giants. So DeepSeek is an artificial intelligence platform similar to ChatGPT, Gemini, and others that are produced by the major tech giants here in North America, specifically in the United States. What happened with DeepSeek on or about February 19th, it was revealed that this Chinese-based artificial intelligence platform was able to achieve similar results without the enormous capital expenditures utilized by North American tech giants. And that threw a wrench into the capital markets in mid-February, and the market started to slide at that point, leveled off sometime in March, and then we had the tariff disruption in April, which created an additional slide. And the response to that issue is as follows. DeepSeek is now history. The market already knows everything that they are going to know about DeepSeek and its impact. The Wall Street investors have already voted with their feet. They're bidding up the share price of US tech giants, and DeepSeek is no longer a concern. One of the things I keep repeating in my newsletters and in personal interviews with clients is you cannot approach investing from a position of fear. You have at all times have to maintain level head, and you have to ignore the volatility and the emotions that are being reflected in the financial media and other forms of media. As Warren Buffett says, if you cannot control your emotions, you cannot control your money. So this is critical to your financial success. We are here to help you control your emotions. This is why you have a third party managing your money. When you do it yourself, you run the risk of making the wrong decision at the wrong time. During the quarter, through my weekly newsletters, I continued to comment on the events as they were unfolding. At the peak of the market in the first quarter, I made the following statement about tariffs, which had already entered the concerns of the media and other financial participants. And I said, media narratives about tariffs being inflationary are wrong. There's no real world evidence of tariffs having an inflationary impact. They weren't inflationary during President Trump's first term, and they weren't inflationary when used in the 1920s and 30s. See the following chart, which is shown on your right. In the newsletter about a month later, I said, revered and Nobel Prize winning economist Milton Friedman correctly explains that inflation is caused only by an increasing money supply. Tariffs, even if enacted temporarily, do not increase the money supply and therefore cannot produce inflation. An increase in the price of a foreign product creates the substitution effect, whereby consumers choose the lower priced domestic alternative. For the American economy, substitutions are easily accessible. So that's what I said. And as we have all witnessed in the course of the second quarter, inflation has not materialized. Let's take a look at some of the biggest catalysts of the second quarter. We continue to watch what the Federal Reserve Board is doing, the U.S. Central Bank. We continue to monitor tariff news as they unfold, including the trade war with China. And we continue to monitor events in the Middle East. Let's take a closer look at the Federal Reserve. Here is the state of inflation. According to the Department of Labor, Consumer Price Index or Consumer Personal Consumption Expenditure Index is currently sitting roughly at 2.6%. This is the most watched inflation indicator by the U.S. Central Bank. They have said historically over the course of the last several years that they are data dependent in order to make changes to the central bank interest rate, and they want to see inflation settle down and not start to jump back up. As you can see from this chart, inflation leveled off at the beginning of 2024 and has continued to meander its way downward. The central bank had a major interest rate cut just before the election last year, even though inflation at that time was up approximately 3%, and today it's lower than that. So their narrative about being data dependent seems a little to have been contradicted so far this year. Although the Fed looks at the Personal Consumption Expenditure Index as well as the CPI for inflation data, we know that the methodology used to collect that information is outdated, and it is usually on a time delay, so it's not as accurate. We rely on a live, real-time inflation, private sector inflation indicator called Truflation. You have all seen this chart before in my newsletters. At present, Truflation shows an inflation rate that is well below the Bureau of Labor Statistics, which is reported at 2.7. Truflation is currently showing an inflation rate of roughly 2%. That bounces up and down on a daily basis, but it's oscillating currently at 2%. So in effect, the inflation rate is at the Federal Reserve's target, and the fact that they're not cutting interest rates brings into question their motives. In June, we just had an inflation report last week to reflect what happened in June. It was released on July 15th. The headline CPI indicator met the expectations of an increase of 0.3% for the month. The core CPI, which excludes food and energy, came in below expectations, which was very positive. Further evidence that tariffs are not causing inflation. Excluding shelter, inflation looks even better, showing it at about 2%, even with the government's Bureau of Labor Statistics inflation indicator, the Consumer Price Index. So where are interest rates headed? Will the central bank cut interest rates? Well, according to most Wall Street observers, the central bank should have been cutting interest rates already before today. But as I said, their motives have been highly questioned by both myself and others. Currently, according to the Commodities and Exchange Index, the expectation is that interest rates will be cut sometime in the final quarter of 2025, beginning possibly with middle of September, which is technically part of the third quarter. But during September and possibly December, we can expect at least a 0.25% cut for each of those time periods. One of the Federal Reserve board members, Mr. Waller, has indicated that he thinks the Fed should cut rates this month, and the Federal Reserve meeting is occurring next week, a week from tomorrow. However, he is in the minority, and the probabilities indicate that the Federal Reserve will stand pat next week. What's going on with tariff news? The predictions regarding tariff disruptions were borne out. Our predictions came true, which is that it was much ado about nothing. Inflation was never going to be in the cards, according to our understanding of what tariffs represent and how they impact or don't impact inflation. As we all know, the financial media and the media at large lost their mind over the last quarter on this subject matter, and created and instilled a tremendous panic in the economy about tariffs, all for no reason. The market ended up dropping very rapidly over a period of 3 or 4 business days in early April, only to see a dramatic recovery later on. This was anticipated by us, and we did not panic into the tariff narrative. The U.S. is focused on maximizing their domestic interest, utilizing tariff negotiations or trade negotiations, and everything that the president says is meant to be a public negotiation. So he's not just speaking, he's speaking in a manner that is triggering the counterparty to the tariff negotiation to believe a particular narrative that he is pushing. So everything is a public negotiation. You don't have to worry about what the president is saying. He's not speaking to you. He's speaking to other countries and their negotiators. And yes, it creates some disruption in the media, but it's the media who casts a spotlight on it and makes a big deal about it. The rest of us can just ignore this. We've been here before. We saw it in 2018 during the first Trump presidency, and we don't need to worry about it. For the record, here's something that is lost on the media and is also lost on most observers of the capital markets. As you can see, we're showing you a table for the percentage of GDP. GDP is gross domestic product, which is the size of the economy measured on an annual basis. The percentage of the economy that the U.S. is reliant upon for imports is just 14%. In other words, the United States is the most self-reliant economy on the planet, coupled with Argentina, but Argentina obviously is not as developed as the United States is. Canada is far more reliant upon imports than other countries, as you can see at 32.7%, but even the European Union is the most reliant upon imports at 46.3%. So when these trade negotiations are going on, the U.S. has all the cards in the deck in their hands. They essentially drive the negotiation. They don't even need to have a negotiation. They can arbitrarily choose a tariff rate impose it on their trading partners, and the trading partners will have no choice but to accept it or attempt to negotiate it lower by giving up some of their economy so the U.S. can sell more into those economies. Correspondingly, the U.S. Is exporting only 11 to 12% of their GDP. So they would love to have that number go up and have their exports become a bigger percentage of their GDP. So they're very much incentivized to increase exports. Imports are not that important to them. In fact, in my view, given 3 more years to build out the domestic supply chain and domestic factory production, the U.S. can probably shrink that 40% figure to something even below 10%. So when the media makes a big deal of tariff negotiations and deadlines for tariffs, really, they're not very meaningful. The timeline for the tariff negotiations began on April 2nd, so-called Liberation Day. Sweeping tariffs were announced. Stocks sold off the very next day, 4.83%. They continued to sell off in a succession of 3 or 4 trading days. And then on April the 9th, a pause was announced and the market rallied 9.52% in a single day, the single largest increase in the market in probably at least half a century, if not longer. This is an excellent illustration of why you as the investor should never contemplate making changes to the asset mixture of your portfolio in the midst of a stock market turmoil. The market information circulates around the planet at light speed today. It doesn't take more than a second for changes in information to occur, and there is no one who can make changes to the portfolio sufficiently fast to adjust for what's going on. So just forget about attempting to make changes. That is our job. It's our job to monitor. It's our job to make modifications as required, and we will take care of that for you. And we did a lot of that in the second quarter, and I'll touch on that shortly. As you can see, the market recovered tremendously. By the early May, the market had completely recovered the declines of April. On May 12th, there was an announcement of a tariff pause with China, which continued to contribute to the market's recovery. As you can see, for the entirety of the quarter, stock market gained over 10%, and MedWealth gained 14.5%. We were 4% clear of the S&P 500 index, which is incredible outperformance for a 3-month time frame. This demonstrates the importance of investors remaining invested. During short-term disruptions, it is once again important that you maintain a level temperament. As you can see from the chart on the right-hand side of the screen, earnings estimates over the last year have gradually been brought down by Wall Street analysts in anticipation of the Trump presidency, in anticipation of tariff negotiations. They keep expecting that corporate earnings are going to get lower, lower, and lower. But we haven't seen corporate earnings suffer yet. Now we are entering the second quarter earnings season right now. We're going to be hearing over the next 4 weeks if there have been any impacts from tariffs on corporations. Some companies, I'm sure, will have said we're not going to give forward guidance because tariffs are opaque, while others will not be impacted. Overall, it remains to be seen, but Wall Street has very low expectations, and that's a very good thing because the lower expectations of earnings, the easier it is for companies to beat those earnings and cause share prices to go up. Long term, these negotiations are excellent for the United States. It makes them more competitive for their domestic producers and increases the domestic supply of goods and services. It will result in lower prices for consumers. The negative impact on earnings could be that costs could go up and consumption can come down. But as I said earlier, we have the substitution effect to replace that. Negotiations currently are ongoing. Some deals have already been made. The ones that have not been made, as I said, unilateral tariffs have been imposed by the U.S. as they have the ability to impose given their strength and size and scope of their economy. And then that will provide the incentive for their trading partners to come to the table and negotiate something lower. What about the Middle Eastern conflict? We heard all sorts of things during the Middle Eastern conflict, including, is this the beginning of the Third World War? I would argue that the preceding 4 years brought us closer to Third World War than anything that's occurring this year, since the U.S. was projecting an enormous weakness to the global community during that period. Right now, the U.S. is projecting strength, and that is keeping all players in check, and will likely reduce the temperature in the geopolitical field as time wears on. As we can see, during the attacks in Iran, which occurred on June 23rd by the United States, oil prices, which had been going up in anticipation of tensions increasing, suddenly collapsed because it was a very successful strike and took out the risk of Iran developing nuclear weaponry. Wall Street has voted with its feet. The stock market from the beginning of April to the end of June, as I said, is up 10.5%. So clearly there's no fear in the financial markets about Middle East escalation. And by the way, this whole discussion about nuclear war, I've been hearing this for the last 3.5 decades, going back to the early 1990s when the U.S. invaded Iraq because Iraq had invaded Kuwait. And I happened to be on a talk show on CFRB 1010 as a guest, and we took calls, and the amount of fear amongst the investment community back then was immense. People were talking about buying gold because of a potential Third World War. So I've been hearing this talk about Third World War now for 35 years. If we get a nuclear war, you don't have to worry about your money. We're all going to be dead, and so that will be the end of that issue. So what happened in the stock market in the second quarter? As you can see, among the 11 economic sectors, the leading sectors were technology, communication services, industrials, and consumer discretionary. 3 of these 4 are classified as aggressive, growth-oriented sectors, and that's what you want to see in the stock market. Actually, what you want to see is all sectors participating, but when the aggressive sectors are leading, that is a good indicator. It means investors are optimistic. They're taking more risk with their capital, and that's a good thing. So tech, communications, and consumer discretionary. At the reverse end, we saw real estate, healthcare, both of which, and consumer staples, all of which are defensive sectors. They lagged significantly, and the most lagging indicator is energy, but that's very cyclical. Year to date in perspective, this is what the stock market looks from the beginning of the second quarter to the end of the second quarter. The previous peak had occurred in the first quarter on February the 19th. By the end of the second quarter, what we saw is a resurgence to all-time highs. So the round trip from February 19th to the bottom on April 2nd or thereabouts was approximately 19%. At 20%, that is considered a bear market. So we came within a whisker of registering a cyclical bear market. And what we mean when we say cyclical means short-lived. There's another bear market called secular, which means long-term. And there's nothing in sight in terms of a secular bear market. The market, in its rapid gain following the February, March, and April sell-off, has rallied approximately 25% in a very short period of time. So it is expected that following such a tremendous and rapid recovery, the market is likely going to take a breather for a little while and either enter a choppy period where it trends sideways for a while before resuming its upward trend in the back half of 2025. We said repeatedly in our weekly newsletters and in other communications that intra-year declines in the stock market are quite normal. We've shown this chart before in one-on-one reviews. We've shown this chart in previous quarterly presentations. The red dots represent declines that have occurred within the calendar year. The blue lines, the blue bars represent the actual year-end performance of the stock market. As you can see, in every single year, whether the stock market was up or down, there was an intra-year decline, and the average decline was roughly minus 8%. And in many years, it was significantly more. But as you can see, even in years where the decline was greater, most of the years the market ended up with positive returns. I point out to 2020, where we had an intra-year decline because of the COVID shutdown, minus 34%, yet the market ended up on the year by 16%. So don't worry about intra-year market declines. They're quite normal and expected, and it does not mean that the market's going to end up the year in a negative territory. Among the questions we had that I showed at the beginning of this presentation, someone said, when can we expect the recovery? My response was sometime in the second half of 2025. And by year end, I think we'll be at all-time highs and possibly with a positive return to our model portfolio in the range of 7 to 10%. And we're certainly already past that in US dollar terms. We just got to get the Canadian dollar to cooperate, and we're going to get past that in Canadian dollar terms as well. The lesson of this past section is, and according to Warren Buffett, real fortunes in this country have been made by people who have been right about the business they invested in and not right about the timing of the stock market. Warren Buffett doesn't try to time the market, neither should you. MedWealth versus market performance. Here's what it looked like in Q2. The dark green line is MedWealth. The light green line is the S&P 500 index. Now, you cannot invest in the index. You can invest in the SPY, which is an ETF. The ETF had a 10.47% return. We had a 14.47% return. So we were 4% ahead of the index, which is no easy feat and is achieved by a fraction of a percent of the portfolio management population in the world. So this is incredible. These are incredible results. We're very proud of our achievement, and we're even more proud at the fact that this was done in one of the most volatile and controversial quarters in the last 5 years. On the same chart, you also see the exchange rate of the Canadian dollar versus the US dollar. The US dollar devalued by about 5.2% against the Canadian. That is acting as a drag on performance so far this year, and also during the quarter. But keep in mind, in 2024, there was a corresponding decline of 5% for the year, which contributed to our performance. So we'll see how the second half plays out in terms of the currency. Currently, the Canadian dollar is deemed overpriced against the US dollar by a magnitude of about 8%. So at some point over the next 6 months, a year, 3 months, timeline is unpredictable, the US dollar will reappreciate against the Canadian dollar. And the currency adjustment has not occurred exclusively against the Canadian dollar. The US dollar has generally weakened against all currencies around the world. This is a chart that shows the performance of our MedWealth portfolio against our benchmark since inception. And as you can see, we've done extraordinarily well relative to the benchmark. Performance here is shown relative to where Canadians are keeping their money. Most people keep their money in one or more of these 7 listed all-in-one portfolio solution mutual funds offered by the major banks. MD is an offering by Scotiabank. So we have 2 Scotia offerings shown here, the MD Precision and the Scotia Selected Balanced. And then we have RBC and PH&N. PH&N is a division of RBC. So again, we have 2 RBC products showing here. And then, of course, TD, BMO, and CIBC. So this is where most Canadians have their money invested. And as you can see, over various timelines, our model portfolio has managed to provide better performance. On $1 million invested since inception, the average consumer mutual fund out there, it has earned 6.8% per year gross before fees. Our portfolio has earned 12.3%. So on $1 million, that is $54,000, roughly $500 per year of opportunity cost that investors are giving up by remaining in those bank-run all-in-one portfolio solutions. I know some people on this call and some people amongst our client base still have money at the banks, and I would encourage you to consolidate your affairs under our care. We clearly are doing a better job, and there is no difference in risk in dealing with our firm because National Bank is our custodian and all client assets are held with the custodian. So you have the same level of safety with National Bank as you do at any of the other Canadian banks. Now, there were significant more MedWealth portfolio modifications during the second quarter. As I said, it was the most consequential quarter since the inception of the portfolio 4.5 years ago. And given the volatility associated with the tariff craziness, there were substantial changes. The pie chart on the left shows what the asset mixture was amongst the various industries in the US at the end of the first quarter. As you can see, the biggest component was in the area of healthcare, followed by consumer staples, 22 and 20% respectively. Financials were another big part, 21%. Then we had communication services at 13, infotech at 8.4%. Now that was already a modification that had been underway from the February 19th peak in the market. So between that peak and the end of March, the portfolio had already begun to move toward a defensive construct in order to defend the capital of our clients. So the March 31st asset mix does not show the positioning of the portfolio at the peak, which was definitively more tilted more toward growth. But it demonstrates that we were very active, even in the early stages of the decline in the market, and we continue to be active. Once I determined that the market had turned for the better in April, I redeployed the money into the growth sectors in order to catch the upswing. And as you can see, the difference over the quarter is that information technology went from 8.4% to 32.2%, 15% in consumer discretionary, which was another growth sector, 12%, 12.5% in industrials, and 11.8% in communication services. Those are the four growth-oriented sectors. More so infotech, consumer discretionary, and communication services. So the portfolio has changed dramatically in the second quarter. This shows you a comparison between our portfolio and the S&P 500 index, but only their top 25 holdings. So we're comparing apples to apples because we have 28 holdings. And so, as you can see, despite the fact that we have a large representation in information technology, it is still not as large as it is represented in the S&P 500 index. So we, although have performed closely to the index in the last quarter, we've done materially better, and we've done materially better because we're not a mirror of the index. We are still quite different. We're constantly monitoring the quality of companies we are investing in. There's a metric we use called portfolio health. It's supplied by one of our analytical firms, Seeking Alpha. And we compare the health of our portfolio, which is the quality of the underlying company's financial profile, based on a score from 0 to 5. As you can see, the top 20 stocks in the S&P index have a health score of 3.48 out of 5. The Dow Jones 30, 3.38. And the Magnificent 7 tech stocks, 3.58. Our portfolio is roughly 3.9. Our portfolio scores very well on the metrics of growth, profitability, price momentum, and earnings per share revisions, which are critical to future success. So what can we expect in the third quarter? Well, the potential catalysts are Fed policy, when will cuts finally occur? The risk of recession if they wait too long. The new U.S. budget, which just passed recently, it is referred to in the U.S. as the big beautiful bill. They name all of their bills in the U.S. some kind of adjective. So this one's called the big beautiful bill. Includes major private sector stimulus. And of course, we're monitoring tariffs and corporate earnings, how they are going to impact potentially corporate earnings, and the direction of the US dollar. Let's delve into Fed policy. The current Fed interest central bank rate is 4.5%. True inflation rate of inflation, I should say, is 2%. That means a current real interest rate. So the term real means the nominal rate, which is 4.5%, minus the inflation rate, which is 2%. That equals 2.5%. Historically, the real rate of inflation has tended to be between 1 and 2%. And the Federal Reserve has built in their models for projections into the future a real interest rate of 1%, given the aging demographics of the United States and other countries in the world. So if their neutral rate is 1% and the current real rate is 2.5%, that means there's space for a 1.5% cut in the central bank rate. I would argue, and I did argue earlier this year in one of my newsletters, that the central bank missed several opportunities to cut interest rates. They should cut interest rates, and the president currently is making his case, as someone described. He is negotiating with a ref, to use a basketball analogy. He's working the ref to try and get him to change his call.
You may want to explain what the neutral rate is for people so they understand that.
So the neutral rate is an expectation of what inflation is going to be based on the growth expectations of the economy over the long term, factoring in such things as demographics and economic growth. So it is something that the Fed is using as a benchmark. And that means the nominal interest rate, if we have an inflation rate of 2, the nominal interest rate should be at 3, not at 4.5. So the gap between 4.5 and 3 is 1.5.
And to be above the neutral rate means that we are in restrictive fiscal policy, or monetary policy, excuse me. And if we are below the neutral rate, we are in stimulative monetary policy.
Okay. Thank you. So by waiting too long, the Fed risks slower economic growth, which will bring down consumption, which will bring down investment, which will hurt housing, labor market weakness, unemployment, and increases financial instability, as high interest rates may trigger private sector credit defaults and increase the stress on the U.S. national debt. So the Fed policy is critically important to be proactive, and they have not been proactive throughout the tenure of the current Federal Reserve chairman that began in 2018. He has consistently been, as they say on Wall Street, behind the curve, always changing interest rates too late. Here's another reason why interest rates need to come down. Private sector jobs growth over the course of the last 3 years has been trending downwards and has flatlined. So to get the private sector jobs growth going, one component that will help will be an interest rate that will allow people to borrow at reasonable rates. What we don't realize here in Canada, because our rates have already been cut, and in Europe, their rates have already been cut, but mortgage rates in the US are hovering in the range of 6 to 7% per year. And they tend to lock in for periods of 30 years at a time. They don't do resets like we do here between 1 and 5 years. So having 30-year mortgage rates at between 6 and 7.5% is materially detrimental to the U.S. economy. And that's why it's another reason why it's important that interest rates come down. Will there be a recession? Let's define what a recession is. It's 2 consecutive quarters of economic contraction. At present, the New York Federal Reserve Board, one of the 12 Federal Reserve districts, is projecting the second quarter GDP to come in at 1.7%. We're not going to have a final number probably for another month, but that is the estimate. And they're estimating the third quarter to increase by roughly 2.5%. So clearly they're not expecting a recession. Recessions are often follow decreases in the money supply, and at present, the money supply is neutral to increasing, and certainly will be increasing further with the big beautiful bill, which is implemented tax cuts that can create more money into circulation and increase the money supply. So the risk of recession in the United States is low to very low right now, unless the Fed waits too long to cut rates. And what about the budget? So the so-called big beautiful bill is comprised of 3 major segments. making permanent the 2017 tax cuts, which were initially introduced by the first Trump presidency. Lower tax on tips and overtime, which is certainly going to help the bottom 20% of workers in the United States. A tax deduction for the interest paid on car loans, as long as the car is made in the United States, which again will help all American residents who purchase American cars. But the majority of people who will benefit will be the ones in the bottom 20% of the population. Deregulation is going to allow the economy to move more rapidly. Regulatory delays usually results in companies not being able to open production on factories or to begin manufacturing on a timely basis or to explore for resources. The deregulation is going to accelerate this process and allow the economy to move more productively. And of course, reduced government expenditures. There's a reduction in waste, fraud, and abuse, which are superfluous to the needs of the American population, and provide tighter fiscal control in future to try and tame the U.S. deficit, which has nearly doubled in the last 5 to 6 years. How about the impact of tariffs on corporate earnings? As we can see here, based on information from research firm FactSet, corporate earnings are expected, that's the black line, are expected to continue trending upward. Currently, the price earnings ratio, which is one metric of the stock market valuation, it's not the sole metric and it's not the one that everyone should be relying upon, but it's a widely followed measure. Currently, the PE multiple is 22.2, which is higher than the historical average for both the last 5 and 10 years. Earnings growth is expected to be about 9.3%, which is above the historical trend of roughly 8%. So given the elevated valuation of the U.S. market, we could see some short-term choppiness and the market trending somewhat sideways, if not even have a minor pullback before resuming its uptrend and reaching for new highs in the back half of 2025. And of course, geopolitical and macroeconomic shocks always pose a risk to the market, but they cannot be predicted. Here's another measure of overbought, oversold conditions. And as we can see, we're currently in the, according to this particular company's metric, which is different than the way CNN uses their metric of fear and greed. But both are in the definitively in the greed category, which means as a contrarian indicator, we are looking at a likelihood of a bit of a pullback in the market in the short term. Nothing to be concerned about. You don't have to make any changes to your portfolio. Technicals indicate that the bull market remains in control. We have an uptrending market over the long term, and we expect this to continue. Here's the American Association for Individual Investors and how they're feeling in terms of their sentiment. Currently 39.3 bullishness, that's up here. The historical average for investor bullishness is 37.5, so we're slightly above the historical average. And so that's, again, another contrarian indicator that potentially we could see the market go sideways or take a short-term pullback. What about the value of the US dollar and what is likely to unfold in the future? Well, we can't predict what's going to unfold in the near future or even in the longer term future, but if we look at probabilities and trends, the fact that the US dollar has gone down this much this year, as you can see, compared to historical patterns of behavior, indicates that this is an outlier, statistically speaking. It is unlikely to continue trending downward, and we're likely going to see a reversal coming, or the reversal will likely come due to higher yield differentials in the US versus foreign countries, especially Europe and Canada. The US dollar will attract more capital inflows as it provides incentivization for companies to onshore in the US to build and invest. There's lots of room for rate cuts at the present time. The US Treasuries as a security or as a reserve currency for other countries around the world and other economic zones like the European Union still are the preferred foreign reserve currency. And so the US dollar will likely increase again in value at some point. Here is a history of the US dollar as the world's reserve currency. As you can see, there's a huge gap between it and the the euro currency. And all other global currencies combined make up 10% of world reserves. The yen is 6%, the British pound is 5%, and the Chinese renminbi is nowhere to be seen. So all this narrative about alternative foreign reserve or world reserve currencies is just nonsense. This narrative about the US dollar becoming an irrelevant foreign reserve currency has been taking place for the last 6 decades. As you can see, this chart starts in the 1970s. And so the dollar has been oscillating up and down. And every time it goes down, the discussion starts about de-dollarization and how other countries are going to step up, become the world's reserve currencies. That's not going to happen. There is no other country that rivals the economic might and the military might of the United States, and therefore no one's going to be displacing them, at least not in my lifetime. On the financial planning topic, as we can see, the tax-free savings account maximum contribution levels are $7,000 per year for 2025. If you have not maximized your TFSA and have the means to do so, you should do so. On a cumulative basis, for people who have not maximized their TFSA historically, the maximum contribution room is $102,000. For RRSPs, the new limit for 2025 is $32,490. Once again, if you are still under the age of 71 and have employment earnings, you should be maximizing that number to get your tax break. And we also have the first home savings account, which has a maximum $8,000 contribution. If you're a first-time home buyer and have not yet purchased your first home, it's a great way to save money. No matter what you hear in the media, just remember, it's never paid to bet against America, according to the great Warren Buffett. Thank you for your time. We'll now open the floor to questions. Alexander, you want to take over?
If anybody has any questions, just feel free to post them in the Q&A and we can address them right now. Otherwise, if you don't feel comfortable posting your questions now, we're happy to answer any questions that people have, either via email or via call later on. Okay, I don't see anything in here right now. So if you want, you can go ahead and wrap up that, unless anybody wants to post anything quickly, or you can even raise your hand if you want to jump in. If you can't type fast enough, you can raise your hand and I can unmute your mic.
I want to conclude tonight's presentation with an anecdote. I repeat in my newsletters on a regular basis that one of the major keys to success in investing is approaching your investments from a position of optimism and not fear. Remember that the media is there to scare you. The more they scare you, the more people they attract. The more people they attract, the more advertising revenue they generate. Their objective is not to give you the truth. Their objective is to scare you. My objective is to maintain the emotional detachment and to provide you with perspective and to provide you with historical norms and economic norms. When my son Alexander was young, he played baseball. And as a young boy myself, I also played baseball, and I was an excellent hitter. Late in my baseball career, they figured out that I was too good a hitter, so they started throwing the ball directly at me to hit me, to try and intimidate me and to scare me. And they succeeded. But I made sure that when Alexander played baseball, that he would learn that lesson and not be restricted by it. So when he was a young boy, he was a good hitter, and then a couple of times he got hit and he started showing shyness at the plate and his productivity diminished. So I pulled him aside and I said, look, in the game of baseball, on occasion when you're batting, the ball's going to hit you. It's going to sting. It's going to hurt a lot for a couple of minutes, but then it's going to go away. But if you can get over that in your mind, if you understand that once in a while, that's a sacrifice you pay in order to get more hits, then you're going to be more successful. And he took my advice. And Alexander became a tremendous hitter and was always my most productive hitter. I coached all of his baseball teams. He was always my most productive hitter. So learn this lesson when it comes to investing. You cannot be fearful. The stock market, even when it's going down, is not going to zero. It's going to go down for a while until enough people have sold and there are no more sellers. And then the buyers come in and the stock market resumes its uptrend. So volatility is not a risk. Volatility is an opportunity. And every time you see the market sell off, if you have money available, that is the time to add to your holdings. But certainly I encourage you to ignore the financial media, to ignore the media in general, and focus on the future being optimistic and things generally improving over time. Thank you very much for attending, and we look forward to seeing you soon.
Thank you very much.